Howdy, everybody. Welcome to Liberty Call. Today is Thursday, June 13th, 2024. Hope you're having a fantastical day out there. You can see my main man, Jake, back here. Super excited about today's news. Not really. Anyways, all right. Beautiful day here in Colorado. I apologize for being about an hour late. Had to go run to Lowe's, help keep them in business. Had to go get a few home improvement items. And anyways, hope you're having a fantastical day. If it is your first time watching the Liberty Call, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All right, let's check out today's numbers. And man, it looks, I'm amazed every day. The S&P is in the red most of the day, and then it comes back into the green. So whatever sort of rally occurs at the end of the markets, I don't know who's pouring the money in, but it's keeping the markets afloat right now. Dow Jones was down 0.17%, 65 points, closed at 38,647. The S&P 500 was up 0.23%, closed at 5433. NASDAQ up a third, 57 points, closed at 17,665. The VIX was down 0.83% today. It's at 1194. Canada down 1.2%. Brazil down 0.13%, and Mexico down 1.32%. Over to Europe, Germany was down 1.97%, the UK down 0.63%, France down 1.99%, the Netherlands down 0.77%, Spain down 1.59%, Italy down 2.18%, Switzerland down 0.65%, and Portugal down 1.44%. So it looks like Western Europe took it in the shorts today. Russian exchanges split, MOEX down 0.04%, the RTSI up 1.12%. And to the Asian markets, the Nikkei was down 0.47%, Australia up 0.44%, New Zealand up 1.27%. In China, the Shanghai was down 0.28%, the Shenzhen Component down 0.69%, China A50 down 0.31%, DJ Shanghai down 0.47%, Hang Seng up 0.97%, and the Taiwan weighted when it closed on the 12th was up 1.18%. All right, so those are today's markets. Exciting, I know. It feels like we're just waiting for something bad to happen. I mean, maybe it's just me. I've been doing this for a decade and a half. You know, it feels like something. I mean, granted, what I know about things and how the government and the Fed has manipulated the economy and the markets over the last, 4 years especially. But I mean, you could go back to 2009, and it just feels. I mean, we didn't have a downturn for more than a decade, or a significant downturn. And then when we were due for one in 2020, the Fed poured all that money into the economy. So that downturn is going to happen eventually. And I mean, yeah, we had that little dip, in March or April of 2020, but I don't know. I really don't consider that a recession. All right, on to the market recap. S&P 500 in fresh record high as chip stocks ride Broadcom rally. All right, let's get up to my notes here. The S&P 500 achieved another record close on Thursday, driven by a significant rise in Broadcom and boosted expectations of Federal Reserve rate cuts due to further signs of slowing inflation. Yeah, okay. The U.S. producer prices unexpectedly fell in May, with the producer price index, the PPI, dropping 0.2%. Woo, that's a lot. Following a 0.5% increase in April, annually PPI increased by 2.2% in May, down from 2.3% in April. Additionally, weekly jobless claims rose to a 10-month high, further fueling market hopes of Federal Reserve rate cuts starting in September, despite the Fed signaling only one rate cut this year. The odds of 2 rate cuts have increased to about 70%. We'll see. Broadcom surged over 12% after reporting strong earnings and raising its annual guidance due to rising AI demand. The company also announced a 10-for-1 stock split. UBS responded by increasing Broadcom's price target to $17.35 from $16.10, citing a bottoming in new AI networking markets, which had previously been a significant drag on numbers. Conversely, Alphabet fell more than 1%, tempering gains in the big tech sector. The U.S. government sale of $22 billion in 30-year notes saw yields lower than Wouldn't that be 30-year bonds? Probably lower than expected, driven by strong demand. This resulted in 30-year Treasury yield falling to 4.396%, pushing other yields across the curve lower. Tesla gained nearly 3% after CEO Elon Musk announced shareholder approval for his $56 billion pay package. I think he deserves it. And a move to reincorporate in Texas from Delaware. Wedbush analysts noted this removes a significant overhang on Tesla's stock. Conversely, Dave & Buster's Entertainment fell 11%. Oh, darn. Marking its biggest one-day slump since 2022 due to first quarter revenue missing estimates. Additionally, GameStop rose 14% after postponing its annual shareholder meeting to Friday due to a technical issue. And that is the news for today. All right, let's get into some of the data. U.S. weekly jobless claims at 10-month high as labor market eases and inflation is cooling for now. The number of Americans filing new claims for unemployment benefits reached a 10-month high last week, suggesting a slowdown in the labor market and boosting hopes for a September interest rate cut from the Federal Reserve. The Labor Department reported an increase of 13,000 claims, reaching a seasonally adjusted 242,000 for the week ending June 8th. This was higher than the forecasted 225,000 and marked the third consecutive weekly rise in claims, indicating potential cracks in the labor market. This trend was reinforced by data showing that U.S. producer prices fell unexpectedly in May, marking the largest decline since October. The PPI dropped 0.2% in May, following a 0.5% rise in April. Annually, PPI is increased by 2.2% after, we already talked about that. Excuse me. The decline in producer prices, coupled with unchanged consumer prices in May, added to the sentiment that the Federal Reserve might begin cutting interest rates. Yeah, might. Despite these indicators, the Federal Reserve maintained its benchmark interest rate in the 5.25 to 5.5 range and suggested only one rate cut this year, down from a previous projection of 3 cuts. However, economists remain optimistic about the possibility of 2 rate cuts in 2024, potentially starting in September. The 4-week moving average of jobless claims rose to a 9-month high of 227,000, with unadjusted claims spiking, particularly in California, potentially due to layoffs following a minimum wage hike for fast food workers. This uptick in claims suggests a softening demand affecting businesses, especially small companies. Financial markets reacted with mixed signals. Wall Street stocks were varied, the dollar strengthened, and U.S. Treasury yields fell. Market participants continued to bet on a rate cut in September, with the unemployment rate rising slightly to 4% in May. In addition to the labor market data, the Labor Department reported a 0.2% decrease in PPI from, we already talked about that. We've already covered all that. So good stuff. And one last article here comes from our friends over at First Trust. This is written by senior economist Andrew Updike, and this is titled Reality Check. It has to do with the Fed meeting yesterday. All right. The Federal Reserve announced that there would likely be fewer rate cuts in 2024, with only 1 or 2 anticipated. And these cuts are more than likely to occur after the election rather than before. The Fed's statement only had one notable change. The term lack of further progress on inflation was updated to modest further progress. Wow, boy, they're really changing their adjectives there. Reflecting this morning's CPI release. However, the Fed's economic projections showed no changes in GDP growth and unemployment rate expectations for the year end, and only minimal changes in the inflation outlook. Despite this, the Fed adjusted its expectation for pace of rate cuts in 2024 from 3 down to 1. The Fed's forecast for year-end core inflation and the unemployment rate, which are key indicators for their dual mandate of price stability and maximum employment, showed no change from current readings. This indicates that while current conditions do not warrant a rate cut, the Fed believes that if conditions do not improve by year-end, it would then be appropriate to start cutting rates. Why? Additionally, despite minimal changes in their growth or inflation forecast for 25 and 2026, the Fed increased its expected pace of rate cuts in each year, resulting in the same projected year-end rates by 2026. The report highlights the Fed's struggle with the stalled progress on inflation and its uncertain path forward. They believe they have done enough to control inflation, but are not seeing the desired results. I personally would have raised rates up to 8, but that's just me. The Fed has been criticized for ignoring the growth in the M2 money supply and instead focusing on supply changes leading to leading to targeting symptoms rather than the underlying issues. This approach has flooded the system with excess reserves, complicating the Fed's ability to manage economic activity through monetary policy. Confidence in the Fed's approach is waning as they continue to explain away why their forecasts have been inaccurate. The expectation is that the Fed will cut rates once later this year after the elections, driven by economic weakness, leading to higher unemployment and modest progress on inflation. The challenges ahead include the after effects of money printing, excessive spending from Washington, and companies overextending in hiring, which could lead to a turbulent latter half of 2024. And there was some text here direct from the Federal Reserve statement, so I'm just going to read that in its entirety. It's not very long. It's only a couple paragraphs. Recent indicators suggest that the economic activity has continued to expand at a solid pace. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. In recent months, there has been modest further progress towards the committee's 2% inflation objective. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. The committee judges that these risks to achieving its employment and inflation goals have moved towards better balance over the past year. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. In support of its goals, the committee decided to maintain the target rate for the federal funds rate at 5.25% to 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to returning inflation to its 2% objective. Well, let me stop there. Well, why did they reduce the amount that they're rolling off the Fed's books? That would be my question, because all that does is help inflation. Jumping back in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings of labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. And then the voting members were Powell, Williams, Barkin, Barr, Bostic, Bowman, Cook, Daly, Phillips, Kugler, Loretta Meester, and Mr. Christopher Waller. All right. Well, that was basically a wrap up of the Fed meeting, and they basically did nothing and said, yeah, the numbers don't look good, but just like those several paragraphs I just read verbatim, they say a lot in a lot of words, or they say very little in a lot of words. So I guess it's government. I mean, it's like the more degrees these people have, the more they say without saying anything at all. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone has a wonderful evening, and I'll talk to you, yes, you, again next time. Adios.